The IPO market is starting to heat up after the summer slowdown, and our next guest says some companies that are planning on going public or have gone public are doing it a bit too early, leaving investors to assume a lot of risk. For more on this, we're joined by Brian Hamilton. He's CEO of Sageworks, and he joins us from New York. Brian, very good to have you here with us this morning. Can you give us a sense of the size of the IPO backlog right now in the United States?
It's pretty good. What's happening right now is the market is frothy, the market's good, so a lot of companies are going public a little bit early. They're not bad companies, but they tend to be a little bit overvalued, i.e. Facebook, and they really haven't proven earnings. So the backlog is good, the market's good, and it's making a lot of these companies take advantage of that market, and they're going out a little bit early.
Now, a lot of the IPOs in the U.S. that we're seeing have been coming from the tech sector, undoubtedly maybe boomed by Facebook. What is your outlook of those IPOs in particular?
Those ones are the creepy crawlers. Those are the ones you really have to watch. Trulia, Smith Electric, the revenues are going up, but in one case with Smith, for example, the net losses are growing faster than the sales increases. It's amazing. So again, they're not bad companies, but on the tech side in particular, anything around tech, they tend to want to get away with a little bit more than other traditional companies, and those are the ones to watch. Not bad companies, good sales trends, but really no cash flow from operations or profitability. And when that happens, you're just assuming a little risk. It's a matter of timing. If they just waited another year or two when they really prove their financial performance, I'd have no objection to this.
Is that the problem with Trulia, one of the companies you just mentioned, online real estate service? Why are you down on them?
Okay. Look, here's what's going on. The sales are going up. They are still unprofitable. Now, they did turn the corner. They have cash flow from operations that are positive. But right now, in the past 12 months, so they don't really have a good track record. Remember, too, it's a good question because these are smaller companies, right? They're only doing about 40 million. They're not doing $1 billion. They're very formative companies. So if you've got a formative company, it doesn't have a great financial track record, just remember, as an investor, you're assuming a little bit of risk, and that's the issue. Not that they can't be great companies, but right now they're smaller companies, and they are losing money, and that's not a good recipe in terms of risk. Now, one last thing on that. If you had more risk, you'd want more return, right? That's the whole idea. But these companies are valued at 10 times trailing sales. So they have pretty frothy or rich valuations. So it's a situation where maybe decent companies, but they're not profitable. And if you go in and take the risk, you're not buying at a low value. And it's really market driven. It's the way you guys led this segment. The market is good right now, so these companies are just going out too early.
And so let's compare Trulia with Zillow, which is its main competitor, which has done well. Is part of the reason that it has done well is the fact that it is profitable?
Of course. Look at the great companies over the past 30 years. You look at the Microsofts. They traded at about 5 times trailing revenue. They were profitable. Google, profitable. It does not mean that there are certain companies that go out and are unprofitable and they're not good investments, but it's much more risky. That's the whole thing. Finance, can be very difficult. We make it difficult, right? But really, are sales growing? Are the companies profitable? Do they have positive cash flow from operations? Check, check, check. If they're in a good market and the value is good, that's when you get in. But when you go against those basic barometers, you're just taking a risk. And the whole thing is always value. Look at Facebook. You guys remember we talked about that last time. It's not that the company's not good, but their valuation was so rich. And the tech companies are the culprits. They always think they can get away with huge valuations just because they're in the tech sector and they think everybody's going to get in, they'll be the next Microsoft or something like that. That's very rarely true.
You mentioned Smith Electric just a moment ago as another example, something that's in the pipeline. Tell us a little bit about that company, and again, your caveats with regards to the IPO.
Sure. Those guys are amazing. It's really interesting. For the past 3 years, they're getting huge sales growth. I think it's about 93% each year. But here's the thing. Their profits are growing faster than their sales increases. Profit losses are growing faster than their sales increases. They lost $50 million last year. almost double where they were in losses the year before. So, you know, the money's coming in the front door and it's going out faster in the back door, and yet they still want 10 times trailing revenue. It's amazing to me. Not necessarily a bad company, decent technology, but fundamentally on the financial side, they haven't proven anything yet.
Now, even though the U.S. IPO market is down in terms of new issues coming to market, the amount of proceeds raised is actually up, 5% from last year. Does that mean that investors are not really heeding these kind of warnings and companies are able to raise more money than they expected?
Yeah, it's a good, excellent point, and absolutely, because the valuations are higher, you see. That's why the net proceeds, and I think Facebook might have accounted for about 50% of that. It's hard to say, right? But
yeah.
The point is, yes, that's true. The valuations are a little bit higher. And what's amazing, I'm 49 years old, and I've been following this for 25 years. You think over 20 years or 30 years, the collective memory of us as investors would hopefully improve. But what happens, it seems almost time after time, when the economy is bad, fewer companies go public, you get better buys. When the economy is good, more companies go public, and the buys are not so good. So really, it's all about valuation, and does the company perform well fundamentally? And if that's not happening, then you're assuming greater risk.
All right, Brian, great to talk to you this morning. Thanks for being here.
Great to be here.
That was Brian Hamilton, the CEO of Sageworks, and he joined us, of course.